Hi everyone, my name is Jamie Lee and I'm going to walk you through my portfolio risk and return analysis project. And the idea behind this project is simple but realistic. So I just started my first job and earned a $10,000 signing bonus. And my coworker tells me to go all in Tesla because it's the future, while my parents tell me to just put it into S&P 500 for steady growth. I decided to build my own portfolio and see through data how to find the right balance between risk and reward. So I used the driver framework to organize everything. In the define and discover stage, I focused on what I wanted out most from this investment and what scared me the most. My goal is to grow my money at a decent pace without taking on so much volatility that I'd panic each time the market dips. I wanted to understand what happens when you combine risky high growth stocks like Tesla and more stable assets such as bonds or blue chip companies. So the data set I used includes six assets. Tesla has an average annual return of about 35% and a massive 60% standard deviation. Apple's average return is 22%, less volatility. Johnson and Johnson and ExxonMobil are steadier at around 9 and 8% returns, and Vanguard's bond ETF only returns 3%, barely moves, with a 4% deviation. And finally, the S&P 500 ETF has a historical 12% return and 18% standard deviation. And the key to making these numbers is how they move together. So I also define correlations. Tesla and Apple move somewhat in sync with a correlation of 0.56, while Tesla and bonds are negatively correlated at negative zero point 0.2. The negative link is what diversification thrives on. So now we're moving on to represent. This is where I translated all that information into something the computer can analyze. And I built a covariance matrix that captures how every pair of assets interacts. Looking at that table, we can see that Tesla's high variance jumps out while bonds high variance looks incredibly calm. The off-diagonal terms show each pair's movement affect the total portfolio risk, and the matrix is the math behind saying don't put all your eggs in one basket. Then moving on to implement. I use Python to run 10,000 random portfolios, each one a different mix of these six assets that always added up to 100%. And for every combination, the code calculated expected return, overall risk, and the Sharpe ratio, which tells me how much excess return I'm getting for each unit of volatility. When I ran it, the program generated a scatter plot with 10,000 points displayed on the graph. Each dot represents a possible portfolio. The color scale shows the Sharpe ratio. So the brighter dot, the more efficient the portfolio. And the red dot right here appears as the maximum Sharpe ratio portfolio. And in other words, the best balance between return and stability. When I printed the results below the chart, the numbers were interesting. The optimal portfolio had an expected return around 14% and a risk of roughly 16%, producing a Sharpe ratio close to zero point 0.8. And the weight breakdown came out to be something like 25% Tesla, 20% Apple, 15% Johnson and Johnson, 10% Exxon, and around 30% bonds. And what surprised me most about bonds is even with the low return played a huge role in plugging the overall risk down. Now looking at validate, I wanted to know how the optimized portfolio compared to simply holding in the S&P 500, which would show consistency, and the index fund averages 12% return with 18% volatility, while the efficient mix returned about 14% with slightly less risk. And the small improvement might not sound dramatic, but it means my portfolio achieved a higher risk adjusted performance. And the data proved that diversification isn't about lowering returns, it's about using correlation to reduce unnecessary swings. And that's what modern portfolio theory calls the free lunch of diversification. And so once I had the baseline, I moved on to my evolve stage. So I tried increasing Tesla's weight to 50%, and the return did climb a bit, but maybe up to 16 or 17%. But the volatility also jumped toward 25%. When I reversed that and gave bonds a 40% weight, the return dropped closer to 11%, but the portfolio became remarkably stable. And that made me think about the real life personality differences for someone my age who can handle short term volatility. The more aggressive version might make more sense. For someone that's closer to retirement, the conservative one would be more comfortable for them. And finally, going to reflect here, looking back at everything, the most eye-opening moment was seeing the efficient frontier chart appear. Before doing this project, I thought diversification was just a safe or even boring move, but the math told a different story. It's not about being safe; it's about balance. Tesla's volatility wasn't bad; it just needed a counterweight. When it was paired with a low correlated asset like Johnson and Johnson or bonds, the wild swings smoothed out the portfolio and performed better overall. And another thing I realized is that investing isn't purely mathematical, it's psychological. So numbers help define the possibilities, but emotion defines where your comfort zone is. And with the best portfolio, it's not always the one with the highest return. It's the one that fits your tolerance of what you really want. So to wrap it up, using the driver framework helped me keep this entire process structured and organized. I defined my goal and risk concerns, represented the data visually, implemented the model in Python, and validated my results against the benchmark. And this evolved the mix to test different outcomes and reflected on what I learned about diversification. If this were my real life $10,000, I'd use a rounded version of that optimal portfolio, roughly 40% in growth stocks, 40% in steady blue chips, and 20% bonds. That blend gives me room for upside, but enough stability where I wouldn't be hurt too much on the downside. And working through this project, it turned abstract finance theory into something I could actually see and understand. The code, the graph, the numbers all told me the same story. Diversification works not by magic, but by the math and the statistics. And that's what made this analysis feel real, relevant, and surprisingly personal. And yeah, that's my full presentation. Thank you for listening.